We now move on to the next section in wealth management, and we'll talk about financial planning and performance management of various instruments that are available, and broadly some generic concepts about performance management and generic ideas about how financial planning is important for us in the context of overall wealth management, right? While we will learn more on these terms as we go along, the first session is primarily going to revisit a couple of older ideas that we had kind of discussed around time value of money and how do you look at broad returns in terms of absolute returns and percentage returns. So we are going to look at this data and understand the implication of why does time value of money become important. How do you gauge the overall context of inflation as a risk for any investment, and then move ahead in terms of gauging adjusted return calculations in subsequent sections, right? So let's quickly revisit this concept of time value of money. Now, as the time progresses, the value of the currency that you hold decreases. The value that you hold decreases is because of inflation. So what you hold today in your hands is worth less tomorrow, right? So the value of money today is more than the value of money 2 years down the line. In other words, if someone was to give you 100 rupees 1 year down the line, the value of that today at 0 years is more. So you might actually accept a lower amount today because probably 90 rupees today is equal to 100 rupees next year, right? Now, when we say the value has fallen, it's to say that what you're able to purchase today with 90, a year down the line, you will need 100 to purchase the same thing. So in a sense, the value has gone down, right? We'll understand this in the context of inflation as we look at. So how do you calculate it? Now let's say you have rupees 100 today in your hands. After a year, rupees 100 would become lesser than the actual value of rupees 100 because inflation typically is positive, right? So inflation values will go up, and because of inflation values going up, what would happen is the value of money will go down. So if you today have 100 rupees with you, what you can buy with 100 rupees today, you will not be able to buy the same with only 100 rupees next year. You will need more money, right? Now, how much is the value worth after 1 year? Let's assume that inflation rate is 10%, right? If inflation rate is 10%, then the future value of this 100 is given by 100. And remember, this future value is a sort of a discounting that you're doing and not the earlier future value calculation that you had done. Earlier, when we were looking at future value, we were assuming that this is going to earn a return. Now, assume you hold this 100 rupee note with you, right? Next year, you're able to buy lesser with this, right? That's because the price of everything else has gone up, but you only hold 100 rupees today. So how do you look at this? You basically look at a 10% rate. So 10% is going to be equal to, in other words, your 100 today will be worth maybe around 90 next year. How do you get to that? How do you get to that number is basically you divide this 100 by 1.1. Why 1.1? 1 plus 10%. So the value of 100 goes down to 90.9 next year, correct? What does that mean? If you're able to purchase something worth 100 today, next year, if you have 100 rupees, you will only get stuff worth 90.9 from that. And that is how inflation affects your money or holding capacity. Is this a risk? So this is a risk because it's a risk in terms of the purchasing power. Let's understand how it affects your investments. If your bank FD gives 8% return on capital and you have 10,000 rupees in your bank account at 8%, you will have 10,800 in your hands at the end of 1 year, right? So this is today and this is after 1 year. But if inflation is 10%, then what you could have purchased by 10,000 using 10,000, now you can't purchase the same amount using 10,000. So inflation has taken the value of 10,000 down to, to a lesser number. Now 10,000 would have become this much. So effectively 10,800 would be this number, right? We saw 100 divided by 1.1 was 90.9, so 10,000 would have become 9,090 rupees. But 10,800 rupees is actually worth 9,818 in today's value terms. When we say today's value terms, it is the purchasing power that you have of 10,000 rupees today. That purchasing power, in those terms, you will only have 9,818 next year. So what has actually happened? Even though in absolute sense you have made 8% return on your money, you end up with more money, that is 10,800, but you're able to buy lesser. We can also look at it another way. Let's say inflation is 10%, which means if you're able to buy, let's say, a table today for 10,000 rupees, then next year, if inflation is 10%, you will need 11,000 rupees to buy it, correct? But your fixed deposit is only giving you 10,800, right? And hence, the value of this 10,800 versus 11,000 is the same as the value of this 9,818 versus 10,000 today, right? So in today's value terms, the worth of money has actually gone down, even though you earned 8% return on capital. Get the point? I'll repeat this once. If you had 10,000 rupees that you were using to buy a table today, and next year you're going to use 11,000 to buy that, your investment does not give you 10% return. Your investment gives you 8%. So you only have this in your account, right? So effectively 10,800 divided by 11,000, there's a shortfall here, right? This shortfall is going to be similar to your 9,818 divided by 10,000 effectively. So that's the crux of our understanding in terms of how purchasing power actually goes down in this period, right? What did we do? Bank FD offers 8% interest. So in a year, we would receive rupees 800 as interest. Assuming the total amount was 10,000, you will receive 10,800 multiplied by 1.08 because you're receiving 8% on the money. Inflation increases by 10%, which means the total investment is divided by 1.1. So the value, in effect, our investment value decreases by 181.82. How do you get that? 10,000 minus 9,818 rupees, right? So effectively, what we are saying is that even though you made 8% return on the instrument, the 10% inflation eroded the value of your money, right? 100 became 108, but to buy what you were buying with 100, you needed 110. So you still have lesser than what is needed, right? And that's the inflation risk. This amount is your inflation risk that comes in and becomes an important parameter in your discussion. So what is the adverse effect of inflation risk? When you are evaluating an investment, remember, inflation risk is going to impact a few situations more than the others. It is highest in fixed return instruments such as bonds, deposits, and debentures, right? The fixed income instruments. Why? Because interest payments and principal repayments are fixed in nature. You know that you're going to make 8% in an FD. You know you're going to make 9% in a bond. That's the yield to maturity if you hold it to maturity, right? That's fixed. If inflation goes up, the risk is much bigger. In the case of other instruments like equities, etc., there is at least a possibility that you could make a slightly better return in the times when inflation is high. So at least you can possibly meet what the inflation is. The second is it has an adverse impact on retired persons. People who have retired, their income flows tend to be fixed in absolute terms. So the pension annuity is kind of fixed, right? There's no active income, and the active income. So till the time you're earning, the income increases, right? Income increases till the time you are earning, till retirement. Once you retire, Then the pension gets fixed, your annuity is fixed, you will receive a fixed amount every year, and that's going to create an adverse impact in terms of inflation, right? So what do we do? How do you decide where to invest? We've already seen all the asset classes, we've already seen various instruments that are available. The first thing that you should note is that your investment should beat inflation, at least over the long term, right? No one knows in the short run what happens. Sometimes inflation is higher, sometimes inflation is lower. But in the long run, your investment has to absolutely beat inflation. Otherwise, you're not making a lot of money. That's also, in a sense, important why RBI wants low inflation. Because if the inflation is very high in any country, it is extremely difficult for people in that country to make any returns on a actual basis, right? On the number basis, you were making 8% in the FD as well, but in reality, that 8% was not enough to cover the inflation at 10%, right? Second, your investments typically should have positive cash flows at some point of time, right? At some point of time, your investments should give you positive cash flows, right? Now, that's the primary impact of how you kind of build in the investments that come in. And we also need to kind of introduce at this point of time the return concept. How do you look at returns? Return on investment is a measure made to assess how an investment is performing. So it's essentially performance evaluation. You need to check where is the money put in and what kind of money you are making on the money you have already invested. Every investment can be represented as a set of inflows and outflows, right? So inflows and outflows. Return is the comparison of the inflows versus the outflows. And you are trying to look at the benefit that someone is making in the investment, right? So you're looking at the comparison between the inflow and the outflow. And the idea is to look at what is the benefit you're making in that investments. Return can be negative or positive. Negative return means that the investment has yielded losses rather than any benefits, right? Take an example. A plot of land was purchased for 5 lakhs. That's the outflow, right? And was sold for 4 lakhs. That's the inflow. If your inflow is less than the outflow or your outflow is higher, that's a negative absolute return, right? A bond was bought for rupees 105 and sold for 130. This is the outflow. This is the inflow. Outflow is lower than inflow, and hence you have a positive absolute return. That's straightforward. We don't really need to kind of learn this, but the reality is if total outflows are more than total inflows, you will end up making negative money, right? Now, basics of calculation of return. There are two terms that we typically use. One is the absolute return. Let's say you purchase equity shares worth 20,000 and you sell them at 25,000. Your absolute return is 5,000 bucks, right? In percentage terms, your return is 25%. How did we get that? 5,000 on your initial investment of 20,000, right? So that's 25% return. The rate of return is usually measured in percent terms. This means equalizing the amount, you should represent how much return would you earn if the amount was invested across categories, right? So 5,000 here uh, on 20,000 may be better than 8,000 in a fixed deposit on 50,000 investment, right? In absolute terms, 8,000 is better than this 5,000. But in relative terms, when you look at the return terms, 8,000 over 50,000 is going to be 16% return, right? So in relative terms, when you're looking at percentage terms, it's a better measure. It allows you to compare the return on investment when you're looking at across different kind of investment instruments which are available. It enables a comparison, right? So typically from now on, whenever we are going to look at return in percentage term, return in investment management, it's going to be looked at in the context of percentage terms, right? That's the broad basis of calculation in terms of what returns are. Let's look at a real life interpretation. Why is this important? So we look at this headline in newspaper which says Sensex bleeds on budget day for fifth year. Right now, when you say bleeds, it gives you an impression that there must have been a big fall, right? Now you read 152-point fall in the Sensex on Monday, right? Maybe it's still big, but the reality is the fall was 0.66% in absolute terms. That's because the Sensex itself is close to at a level of 24,000 to 25,000, right? So on that, a 150-point fall is actually just 0.66%. So this headline that says Sensex bleeds on a budget day is probably misleading. Someone who's advising others on investment needs to understand that a lot of your clients would possibly, or investors would be reading this news item. And when you read this news item, this appears to be a little bit misleading because it gives the impression of a panic, right? Or a huge fall. But the reality is the fall was just 0.66%, which is a very normal course of action for any asset class, any instrument during a day, right? So essentially, it is important that this interpretation of percentage returns takes over rather than looking at, absolute data points which come out, right? We keep reading these items that Sensex falls 500 points, right? Now the Sensex value now is around close to 28,000. So if it falls by 500 points, that's still less than 2% as a fall. So in return terms, it's not a huge fall that we're looking at, right? That's an important interpretation of the overall context of returns in percentage terms. We will, over the course of this unit, cover some more calculations of return. When we look at percentage returns, returns could be in the terms of total return you make on an investment. What is the sort of a CAGR, annualized return that you have made on that investment? We'll use IRR and another formula called XIRR in this. We will look at real versus nominal rate of return, where we will look at the impact of inflation as such. And then in real life, taxes are an important reality. So whatever returns you make, there could be a taxation on it. So what is the tax computed or tax adjusted return? We're going to look at that as well. And as we close this section, a couple of quick questions. Explain how inflation eats into the value of your investments with an example, and explain how sometimes absolute return calculations may be misleading. Use an example around the stock markets for this.